Hello, it's good to have you again, and today we'll be taking a look at loans. At different points, many people have considered taking a loan from the bank to start their business. Today we're going to look at the cons, particularly, of doing that, because it's not really the wisest thing to do. You can do it, but it's not really the best thing to do. I have two women who are very versed in finance-related issues. One of them, Hawa Musa, has worked in the banking sector for 25 years. The other one, Mariam Abobo, is a personal finance advisor. So they'll be sharing their views with us about what the pros and cons are of taking a loan to start a business. Now, notice my emphasis. I'm talking about starting. I'm not talking about a business that you've already had going for a couple of years that is struggling and now you want to get some little money in to strengthen it or expand it. No, I'm talking of you've never done a business before. You've seen this idea, you think it's a brilliant one, and you want to get started, but you are cash strapped. So you want to take a loan to make it happen. Is it a good idea? Find out.
The most important thing first when you want to go in for a loan is for you to actually know what you want to use the money for. Okay? What do you want? What is the kind of business are you into? How much do you really need? How experienced are you in that field of business? It's really, really very, very important. And for a starter, loan is not even the best thing for you. That's the way. What my advice to freshers: don't go straight into loan. It is best you acquire the experience that is necessary. It is best you have a little capital. You try that business, because for every business, there's what you call its trial period, and it goes with a lot of experience. So if you don't have that experience of that business and you just come and collect bank loan, you might end up making a loss that you will not be able to pay the bank and the interest. And at the end of the day, you end up losing what you have. Because you need to know what exactly you need. Because if you collect loan much more than what is required, it's another big problem again for you. So knowing exactly how much you need and for how long it will take you, because that's where the feasibility study is very, very important there. And your capital has to be part of it. That's one thing that banks will always consider. Banks will not want to finance your business fully. If you are it is believed that if you are part of a business, you have your capital in the business, you will put in your more effort and you ensure that you don't lose what you have there. So that is one other thing that bank will always consider. So a bank will not want to consider financing your business 100%. Just always have that at the back of your mind anytime you're going into taking loan from the bank.
One thing I notice with people is they're in a hurry to pick up these loans. They normally do not read the terms and agreements, and they don't normally ask even how much they will pay at the end of the loans and all the other nitty-gritty, like I said, the terms and agreements. So most of the time is bulky documents, and they said in Africa or Nigeria, if you want to hide something from someone, you put it in a book. People don't like to read, so most of the time these issues are not hidden, but they are just not being read. So you should take note of all those things. For you to pick up a loan, you need to understand the repayment, what are the default issues, if you need to collapse the loan early, what are the defaults or any other clauses around those things. how much are you going to pay in the long run? That is, what interest are you paying alongside with the loans that you are paying? So you need to take a look at all those things before you decide on the repayment. This is now on the side of you repaying those loans. But on your own part, you need to do your own due diligence. What are you using this money from? Like I always say, most people pick loan to service liabilities. In a layman's term, liability is what takes money away from you and brings nothing in. Assets now on the converse side is what brings in money. So what are you spending the money you are taking loans for? I always tell people, if you spend it on liability, how do you intend to repay back those loans? I need you to worry a little bit if you are starting a new business, because the number one thing, a caution I always put to people is, do not borrow money, most especially from finance houses or banks, for a startup. They normally even do not want to even give you those loans because they would want to see that you've put in effort. What have you gone? Then there is a number, it's a numbers game. They want to see your plan. How have you been doing? And when I add this money, how is going to jump up and you're able to pay me back? But even if it is a family and friends, you will still want to maintain your integrity.
I would not really actually advise you to say, go and just take without the experience. But if you have the experience, you have backups, and you're very sure of paying back, very, very, very sure of yourself. You have to be really, really. The bank will not definitely will ask you for some a kind of backup in case of incasity. What do we fall back on again? If you don't have any option, yes, take, but don't take too much for a start. There is what we call knowing. Everything. There's a know-how in everything. I'm not going to be using technical words, so I'll just say it in a layman language. It's just like somebody that buying and selling. If you know how to buy and sell, you will not you won't make loss. Likewise, if you know how to collect loan and you know how to pay back at the right time, gradually you get used to it. It does become like a trade. You could be somebody that will start with 50,000. The next time it's 100,000. You already know how to collect this money, how to use the money, how to return the money. So gradually you get used to it. By the time you get used to it, it makes it easier to go, easier for you to take and then to pay back, and then you can comfortably collect the loan without any issue. But if you are not used to taking loan from the bank and then paying back, and you have, especially when you have other small things that are holding you back, I will not advise you to go into taking a bank loan like that again. And most important thing is, whatever you take the loan, the purpose that you take the loan, don't deviate from that purpose. It's really, really very important.
I would advise people to take personal loans, but be mindful what you use the personal loan for. I personally, from my own experience, I picked up a personal loan to go into my side business and also put a part of it into real estate. It was taking almost the bulk of my salary because I took the loan against my salary. But guess what? I didn't feel the pinch one bit, because before the real estate business kicks off, it still hasn't kicked off yet, but then it is an asset now. An asset waiting to start bringing in money. The other business brought in money that was able to pay the loan and even give me a substantial amount. So that is what I'm saying. You can pick the loan to go into a business venture that will multiply the money, but not into something that will eat up the money and not give you anything back in return.
So if we say that startups are not advised to go taking loans in order to get the business going, what other options are available? Both Hawa and Mariama have offered some viable advice.
Most people forget that within our households, these are advices I give everybody that comes to me. There is something within your household that is an asset that you don't know. So maybe you will start looking inward. There are things we love packing junk. Sometimes it's sentimental, but I always say you can see there are things that you can lose because you don't really need it. I think I read or listened somewhere that someone said, if you haven't used that thing for 6 months, it has become dormant, just like your accounts become dormant, and that all those money, move it out. So there are a lot of people who are willing to buy those things at a cheaper price, even if it is used or just abandoned. Some people don't even have things that are sitting there. Maybe gifts from weddings and the rest, you keep compiling them, or you bought it and you are not using it, but it's sitting in the carton in your store. Those are things that you can bring out and get money off them to you to start up the business. You can ask family and friends, as long as your liability, your integrity is not in question, to give you that money, because you'll be able to negotiate a good repayment plan, and you will not be given any interest to pay on it, because maybe they would give you a certain period of time before your business kicks off and you start paying. Another part of what I always encourage people is the Adashi scheme, that is the Asusu or the Ajo that people have. You can choose to do that, because then maybe you pick up first, but you all need to understand the numbers in your business you are doing. So you don't go and get into a contributory scheme and people contribute to you and then you are losing money, then you don't have money to repay back, because that is also technically a loan if you are collecting first. So yes, this is another form of way to do it. You go with your own contribution, people contribute to you, you quickly put it and turn around the business, and a lot of people have done that successfully. Turn around that money, and every month they're having that business pay the money they need to service all the contributions that they need to contribute in the end. So those are a few points that I prefer people to really look towards, instead of going to the banks or financial houses to pick up a loan, most especially for starters.
All right. Apart from that, we will now move out of the other source apart from the banking, right? There's the personal, maybe real true relatives. That one is there. At least you're not paying interest for that. Friends might decide to give you pay them back. And if you have a good relationship with your suppliers, a distributors, a producer, he might decide to give you this to go and sell. So that's direct credit. Or the person might decide to give you to sell and return back the money. Or even if we're still talking about poultry, for instance, now, it might be decide that maybe somebody selling the poultry feed will decide, okay, let me give you and give you so period, sell to pay back the money. That's another way you can go around that. There are other philanthropists that want to assist, that might decide, okay, let me give money to so for this. Government comes in once in a while too to assist. NGOs too, they are there once in a while to assist, if you are fortunate enough to get that. Default, like the literal, is just like in the normal English language. You're supposed to do something and you're not able to do it as when due. Now for loan, the default comes in when you're not able to pay the interest and the principal, or the interest when you're supposed to pay, or both interest and principal when due. Now repayment usually structured mostly maybe monthly, for instance. So if it's supposed to be at the end of every month, a part of the interest and the principal, for instance, and you are not able to pay fully, because it's expected that you pay everything, pay everything fully, and you will have something in your account. If you're not able to pay fully, or you're not able to pay, you just pay partially, let me just pay part of it, then you've defaulted for that period. Okay, and the default then means that you have to now balance it up, and you know that next month again another one again is coming again, depending on the agreed period. And usually for this small loan, what bank does is that they have a repayment schedule. You know how much you're supposed to pay at the end, because they are not like those customers that takes this overdraft that they take and put, and then anytime they put inside, it comes down, it goes up. Although that would have even been the ideal this thing, but for them, what is really special is that, okay, you are giving so amount, you're paying back with this period, and within this period, this month A, month B, month C, this is the amount that you're going to pay to cover that period. So if you're not able to pay when you've defaulted, the penalty is not start. It's not for it, then. Well, the penalty now is that, well, it's a loan, something that you must be paid. So usually before you collect it, there must have been maybe a kind of fallback put in place there. So the first step that bank starts with, okay, is a kind of a follow-up to get you to pay back. We don't go back straight immediately to those other fallbacks that is put in place. Good enough, we even want to know exactly why you default. Even before you default, there's somebody monitoring you. Why did you default? What happens? What can be done to remedy the effect? What advice do you need? So try to see how they can advise you again. So you see the bank can now become like your financial advisor again within that period. So if you still can't pay back, then when I go back to the fallbacks that we have in place, is there a guarantor in place? There are some guarantors, like some banks go as far as, okay, these guarantors give us checks to keep with us, to hold, because the loan is not so much that we say, okay, go and bring your landed properties, then bring this, so they go back. It now goes back to, after they've tried, it goes back to the guarantor. This is what we have in place. So if the person cannot pay, if the person cannot repay back, then the guarantor will have to pay the bank. And so in the situation whereby the bank already have the checks signed by the guarantor in place, for instance, the bank will have no option but to present it to get back their money. So usually banks will not give you money without that backup. So that is the last option that we go to. But the first thing is that you must feel the threat until the bank is very sure that you will not be able to pay. They'll put you giving time, they'll pressurize you, follow up after trying to know exactly what is the problem before we now move on to that final backup.
And that's it on today's edition of Money with D. If you got any content out of today's video that made sense to you, I'm trusting that you will like, share, comment, and subscribe, because that is how this channel grows. Also, don't forget to keep visiting, because that's how we gain mileage. See you again next week with more on personal finance.